Our U.S. dollar is losing value every day. It's known as monetary devaluation. And why should this concern us? Well, according to the U.S. Consumer Price Index, over the 20-year period from 1990 to 2010, the U.S. dollar lost 40% of its value, which means that we need $1.63 today to buy what we bought for only $1 20 years ago. Of course, the government refers to this as inflation. But inflation is actually an increase in the price of products and services that is due to an increase in the cost of productivity, while monetary devaluation is an oversupply of available credit funded by an increase of money in the banking system, but without an equivalent increase in economic productivity. Yes, it sounds a little complicated. So think about it like this. Our money, our U.S. dollar, is worth 40% less than it was 20 years ago. But we didn't lose 40% of our money, and we didn't spend 40% of our money. Our money is worth 40% less today simply because there is 40% more of it in circulation, but without a 40% increase in economic productivity. So the value of our currency has simply been devalued by putting too much of it into circulation. And who's to blame? The federal government and the Federal Reserve Bank. Why? Because the federal government continues to borrow money it cannot pay back. In fact, according to the GAO, the Government Accounting Office, our federal debt now exceeds more than $20 trillion. But the government's tax revenue is barely enough to pay the interest on this enormous debt. So the Federal Reserve Bank creates more money and pumps that money into the banking system in order to, 1, devalue this debt obligation and enable the government to pay the interest on this debt with hyperinflated dollars, and 2, offer more credit at lower interest rates to stimulate economic productivity and increase tax revenue. But it's not working. Because our nation's economic productivity, as measured by the GDP, or gross domestic product, is actually lower than the annual rate of inflation, while the annual increase in the U.S. money supply is 3 to 4 times higher. And it's going to get worse, much worse. So what can we do about it? How can we protect the value of our money against monetary devaluation and eventual hyperinflation? By converting our cash reserves into real gold and real silver in the form of pure coins and bullion, which will create a currency alternative that the government cannot devalue. Why? Because real gold and real silver cannot be printed, created, or manufactured like paper currency. The value of gold and silver is determined by a limited or finite supply and a worldwide acceptance as a legal and valuable currency. Think about that for a moment. Gold and silver are much more stable and reliable forms of currency value simply because they cannot be printed, created, or manufactured, and because everyone in the world is willing to accept the value of gold and silver and readily convert them into any other currencies. That's also why gold and silver have historically been a hard currency hedge against these repeated cycles of excessive government spending, inevitably followed by an oversupply of money in the banking system, invariably resulting in monetary devaluation and hyperinflation. Converting cash reserves into real gold and real silver can be fast and easy and without any risk. So, while the U.S. dollar continues to lose value, your hard currency assets won't.